Okay, ready to get started.
Hello and welcome to tonight's edition.
Sam, do you want to just let everyone know that we're ready?
Perfect. Excellent. Is recording ready?
Hello and welcome to tonight's edition of Learn It Live, brought to you by Pepperstone. My name is Tyrone and I am here with Thomas from FX Evolution.
How's it going, everyone?
So tonight we'll be going through and looking at a rules-based approach to technical trading and confirmation.
Yeah, so we're going to basically be covering off rules and how we can use those to help us as technical traders. So just to start, I've always got to go through a risk warning. So I'd just like to let you know that the information provided here tonight has been produced by third parties and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. The information contained in this video is generic in nature and for educational purposes only. Nothing in this video is to be construed as an offer, recommendation, or solicitation to buy, sell, or to participate in any particular trading strategy. Pepperstone does not represent that any of the information provided is accurate, current, or complete, and you should not rely upon it when making your trade investment decisions. You can read the rest there, of course. So what we'll be covering today is we're going to be covering some technical theory, and we're also going to be covering some real examples in the market similar to last week. Then we'll be looking at building a trading strategy using this technical theory. So we're going to actually build together tonight a points-based system for how we can, as technical traders, trade the markets effectively and also with some form of consistent results. So by having things like trading rules and by having a point-based system, we always make sure that we're taking the same type of trades and therefore our results are going to show those as well. We'll then be taking a look at some other live examples in the market right now. So we'll be having a look at things from last week and how they played out. We'll be looking at the channel on the Australian dollar and talking about that. We're also going to be taking a look at the US dollar CAD and some of the interesting things that that's showing in a setup. So how do we define trend easily? I think the easiest way to define it, and a lot of people out there will know what this is simple moving averages or moving averages in general. Simple moving averages are probably the easiest for us to understand, so I'll get Tyrone to go through some basics so we can all get an idea of how simple averages work.
Okay, so for those who don't know what a simple average is, it's the most simple of the moving average calculations. So if we can see here on the slide, it basically adds up the period that you're looking at. So if we're looking at an SMA of 5 here, we're counting up the close of the last 5 candles and basically dividing them by the number of the candles that we're looking at. Okay, so what we're doing is if we put in a 10 or a 15, that's the moving average that we're representing. Now, it's very important to remember that when you're going through the charts, if you're on a 1 hour time frame, a lot of people call them a simple moving average, and they also put the daily tag on it. It's not always the case. It's actually more important to define it as a period, mainly because if we're looking at the SMA 5 on the 1 hour chart, that's going to be a very different moving average if you change that to a daily chart or a 4 hour chart. So we need to be very mindful that the charts do adjust automatically. So it's really good practice to actually start calling it an SMA period rather than an SMA daily moving average. So if we're looking at say a 100 moving average, it's basically counting up the close of the last 100 candles on that time frame and dividing it by 100, and that's giving us our average. So it stands to reason that, of course, the smaller the time frame, the faster it's going to be and closer it is going to be to price. So a 200 moving average or a 100 moving average is going to be far more slower than a 5 or a 10 moving average.
So here we've got an example of 2 moving averages when they cross, and you can see here that the fast moving averages, when it crosses above the slow moving average, so let's say the fast moving average was a 20 and the slow moving average was a 50, that could signify a buy, and if it crosses to the other side, it could signify a sell. So a lot of people use this when they start to trade, and by itself, it may not be the most effective system, but when you start to build it in with a rules-based strategy, I think it gets really, really interesting, and you can get a lot of effective and good results using this kind of thing.
The good thing about moving averages to determine the direction of the trend is it's very easy to see where price is tracking compared to the moving average. So
Very visual.
So if we're in a strong uptrend, for instance, we're going to know that our moving averages will be in order. So the fastest moving average will be a lot higher than the slower moving averages, and we would expect to see price tracking above all of them. So we know we're in a strong trend when price is actually leading the way and all the moving averages are behind it in an uptrend. And of course, in a downtrend, it's the opposite. The moving averages will be on top of it and price will be leading the way.
So let's take a look now at the euro yen off last week and see how we can build this moving average strategy into our trading systems. So if we have a look here, we've got the euro Japanese yen on the 4-hour chart. And if we add each moving average, and we'll go through each one with you, we'll be able to potentially use these in our trading strategy. So if we insert the first one, we're going to insert indicators, trend, moving average, and we're going to start off with a 20. And we're just going to make it red.
So what we're going to use the main popular moving averages. It's probably the best way to start. So we'll use a 20 and a 50. So we'll make the red one the fast one. So that'll be the 20. And the blue one here we see is the 50.
Why do we make it red, man?
We make it red because red cars go faster. Most people associate red cars with fast, so it's very easy to differentiate between the two. We know which one's the fastest moving average here.
So we always go with red.
Always go
That's
red.
just how we seem to do it. And then we'll insert the last one here, which is going to be the 200 moving average.
The main reason we put a 200 moving average in is, although it's a very, very slow moving average, it really gives us a very good definition of what the longer term trend is doing. Although the 20 and the 50 are giving us a good indication of what the recent price trend is doing, when we're all above the 200, we know that we are in a pretty decent long-term trend because it takes a fair bit of price movement to make it go up.
So let's just take a look here at what basically the charts are telling us. So you can see here the 20 moving average is above the 50 moving average, and that kind of happens around this candle here. So after this candle closes, we get the confirmation that the 20 has crossed above the 50. And that's basically telling us that this euro-yen pair could be in an uptrend at this point. We don't want to just use that, and we'll go through how many things we're going to use to get this points-based system, but that's one way of us defining trend. The next thing we want to do is we really want to go to a daily chart, such as this euro-yen daily, and we always want to make sure that the price is currently above, if we're looking at uptrend trades, the 200 moving average.
Yeah, the 200 moving average is a very important moving average, mainly because it's the one that the majority of traders look at. When you hear a lot of the big stock analysts talk about moving averages, the 200 is always a key indicator. So in general stock market terms, the market is considered a bull trend when it is above the 200, and it turns to a bear trend when it goes below the 200. So it's a very important indicator that actually carries through to many currency pairs and commodities.
And you'll see this a lot if you ever read or get the chance to read reports from a lot of those big investment bank firms, UBS, Goldman Sachs, etc. They always mention if price is above or below the 200 moving average on the daily time frame. So what we like to do is we like to come into the daily time frame, we like to see if price is above or below, and that's a very simple way of saying, is the market currently in an uptrend or a downtrend on the daily time frame? Very, very simple.
And also with the 200, I think the key number there is that it actually represents more than half a year of trading, and I think especially on the daily chart, you're talking about 200 days worth of moving average. So yeah, you're getting more than 6 months worth of consensus that those candles are finishing higher, and consequently the 200 is actually moving up in price as well above it.
Yeah, so it's something that we like to see there. We also like to see a little bit of angle. So if it's rising, that's always a good sign as well, because it means the market momentum is with us. So if we analyze this chart, we've got the price currently above the 200 on the daily. That's good. If we then go down to the 4 hour, we can see that the 20 has crossed the 50, and that's signifying a short, an uptrend on the shorter time frame or the 4 hour. So let's just jump back into the slides now and take a look at how we can confirm this trade signal and get other reasons to potentially be involved in the trade. So those are going to be things like candle patterns, Fibonacci retracements, support resistance, which we covered last week, and also sometimes patterns and channels and patterns and things like that we want to start using with our confirmation of trade signals. So if we start off, let's take a look at some candle patterns. Now we've got basically the four that we, I guess, find are probably the most effective when we're looking for confirmations of trend or confirmations of us getting into a trend. We've got the bullish engulfing, bearish engulfing, hammer, and shooting star.
Okay, so these candles we've found are the most successful, basically confirming what we want to see. So look, if you did a Google search on candle patterns, you're going to come up with hundreds of different candle names and patterns, but really what we're looking for is that what the candle actually represents. That's what's important. So we'll quickly go through each of these and we'll actually explain how they work and what they're trying to tell us.
So let's take a look at something like the hammer. So we can see here that basically we've got a bearish market up until a point where each candle is red, and it's obviously the price has been moving down consecutively, and then we're followed by a candle down here where basically price has gone lower during this time frame. Let's say it was 1 hour, and then it's risen steadily during that hour, or at some point it's gone above, and it's actually closed bullish. So it's opened here on the left, it's gone down, and then at the end of this 1 hour period, the market's actually pushed it all the way back up. And what this signifies is a change in potential market momentum. We need to think about it from what's been going on in that candle. It's basically a war. And the bears are shorting, they're shorting for that entire hour, they're shorting for a period of that hour, and then at some point they've lost the commitment to trade in that direction. They've taken profit, they've gotten out of their trades, and the bulls have come in and said, hey, we see value here, and they've pushed that candle, pushed that price above to a new high at the end of that market.
So when we look at what the candle's actually representing, if we look at the overall length of that range of that hammer candle, had that closed a negative candle with the sellers in control, you would have seen that the body of it would have been matching all of the previous bodies, so that would have continued a very strong downtrend. But at one point in that time frame, whether it's a 1 hour or a 4 hour, those candles did look exactly that, a very big, dirty red candle. So with the buyers able to reverse that and close it higher than it actually opened, it's a very, very big sign that the momentum has shifted.
I think it brings up another interesting point. As Tyrone said, at some point, this candle was bearish. It was looking very, very sell-off, and I'm sure a lot of people out there, just like we had when we first started, you can get carried away with trades and maybe get in a little bit too early, and that's definitely one of the things that you want to stop doing. So we always want to wait for confirmation, and this candle, even 2 minutes before the end of this 1 hour candle here, it may have looked completely different, and then 2 minutes later it looks like this, and it's giving us a totally different signal. So waiting for that confirmation, and we're going to keep hammering about confirmation is key.
Confirmation is key.
Tyrone and I know about confirmation is key. So we wait for confirmation every single time now. And while you might miss out on a few little pips here and there, or you might miss out on what you think is a potential trade or getting in early, waiting for confirmation, always the best thing you can do. So as we say here, bottom shadow needs to be more than twice as long as the body. Another way of looking at things is that we always want to see the body, in this case, be very small in compared to the wick or the length size here. And that's because we want to really see momentum shift, and we want to see a market pushing it really far back up and closing it above the high or around that high. And usually, I guess a rule of thumb, probably anywhere up to 80% of the candle, Tyrone?
Yeah, I like to see the body in the top 20% of the range. So if we break it down into 5 pieces, the body should fit in the top 20% of the total range of that candle. But probably an important rule to note is that if it's struggling to actually look like a hammer, it probably isn't. So what we want to do is trade only hammers that everybody else is seeing, because if we're the only ones seeing it and we're the only ones trading it, it's probably not there. So we want to see if it's a very, very clear hammer, you will know.
So let's take a look at some hammers in the market in just terms of example from theory perspective. So here we have the Euro US dollar 4 hour, and we can see here the 2 hammers. And you'll notice that one, some people will probably ask, oh, why does it look like it's red? It's not really so much about whether it's bearish at the end here. It's about, as Tyrone said, if 20% of the candle is basically the body and 80% of the candle is the wick, that's what we want to be seeing, and we want to be seeing a clear candle in the markets, always clear.
Always clear. So even in these 2 hammer examples, you can see the first one has actually got a green body, which basically means it closed higher than it opened. But even though the second one closed lower than it opened, it doesn't really matter because it's what the overall candle represents that's important. So we know clearly that the buyers here seriously took over control and the dynamics completely shifted. So the color, don't place too much importance on the color. What is definitely important in this candle, and also the ones we're going to go into though, is the time frame. So the bigger the time frame, the more important the candle. In this particular example, we've got a 4-hour candle. So we're representing 4 hours of buying and selling, which is considerably important. So if this hammer was on a 5-minute chart, well, it's only really representing a very small snapshot of what's actually happening. But when we move out to a 4-hour or a daily or even, God forbid, a weekly, a hammer is very, very important because it's representing a very big snapshot of the market movement in that time.
The more people that see something, the more people that are probably going to trade it, and therefore the higher your success is going to be with your trade. And that's just like the confirmation is key, or confirmation is something you need to wait for. The higher the time frame, the more people that do see that pattern. So let's now cover shooting stars. It's very similar to obviously a hammer. It's just basically the reverse. So we're looking now at a bullish market moving in, and then basically we've got a point where the market's hit maybe a high, the bulls have taken profit, they've lost commitment, they've gotten out of the trade, and then of course they've pushed the market back down and it's closed somewhere with 20% body and a large, hopefully 80% wick. So as we say here, upper shadow needs to be more than twice as long as the body is preferable.
We can basically apply the exact same rules as the hammer, just in reverse.
Yeah, and then we're looking for a sell-off in the market. So here's an example, again, a 4-hour chart. We like 4-hour charts, and daily, especially for swing trading and pattern analysis and all these kind of things. So the odd yen 4-hour. Another thing is these patterns and these candles work on all of the different charts. So if you're looking at the odd yen, or you're looking at even Bitcoin, I'm sure it will soon be like this. When you see these things, always think about it from the perspective of what does it mean? And it means that this, in this case, the buyers have lost commitment in the trade, they've taken profits, and the sellers have come in and pushed the market lower. And it's that change in momentum that we want to be trading as traders. So it's quite an effective pattern by itself.
Yeah, the shooting star in a lot of ways can be more powerful than the hammer in that markets often short a lot harder than they actually go up. So you'll find in a lot of markets very aggressive shorting happens, especially after a shooting star. So, but they're both very, very effective patterns, especially when you combine them at areas of support and resistance.
Yeah, they're really, really good. So let's jump back into the chart and have a look at this euro yen example again. You probably can see it right now, but what you'll notice is that here we have pretty much a nice bullish looking candle. And this is, again, further confirmation of what we're kind of looking for. So we've got our confirmation of the daily, the price is above the 200. We've got our 20 crossing above the 50, which is excellent because that's giving a short time frame trend. And then we've also got another interesting thing. We covered this last week. We talked about support resistance and the importance of building that into most of our strategies. So from the support resistance, what you'll notice here is we had a level of resistance where basically price hit this point, it hit this point. If we go back to a candle, you notice it hit this point, rejected again, and eventually broke through to the upside when we got our moving average signal. So when the price comes back down to this point, this is the concept of role reversal, where basically a price has been respected before and the price should be respected again. But this time, of course, we're looking for the buy side. So we've got this role reversal area here. We've got our hammer candle confirmation, and we've also got our 2050 cross. So it's starting to paint a really good picture of us potentially looking at getting into this trade.
Now, it's important to note for those of you who were here last week, we were talking about trading with the trend. Now, the shooting star candle and the hammer candle are both reversal pattern candles. But in this instance, as you can see, we're actually, as much as it's a reversal candle, we're actually using it to trade in the direction that we want it to go. So the overall trend here we're looking for is a long trend. We're looking at getting in on the long trend. So although it's a reversal pattern, we're actually using it in our favor. So it doesn't have to, reversal patterns don't always have to signify the reversal of a trend. You can use them in the direction of the trend you want to go to. All you want to do, in this instance, all it's doing is reversing the counter trend.
Yeah, and this, when you build in these strategies and this kind of pattern into a trend, do we think it's going to be strong? It definitely is going to be strong.
Absolutely, it's going to be strong.
And you can see that next candle, that next candle is massive. I mean, it just went boom. And that wasn't due to news either, that particular one. That was just due to the fact that there was a lot of buying pressure coming off this candle. So let's just zoom in here and just talk about how we'd actually place the trade if this was enough reasons, which it isn't quite yet, but we'll talk about another one. What we'd do is if we saw this candle, we'd actually place a pending order, a pending buy order, just above this particular close. So where you can see here, or just above the wick here, so you can see this little bit of a wick, we'd place maybe 1 to 2 pips above this. And the reason we do that is we want to avoid what they call fake outs. So we want to avoid basically a point where the market does this kind of signal, then just starts selling off and breaks down and keeps going. And that sometimes does happen. What we prefer to do is we wait, we put it a couple of pips above here, and we get that extra confirmation that the trade is moving in the direction that we want to go. So that's something that we definitely want to be doing. Now, the other thing we want to do is we want to place our stop losses below the wick of this candle. So it's actually good when we see these candles because it gives us a place to place our stop losses.
It is a very easy place to place them, and also the good thing about them is the move that we expect after a shooting star or a hammer candle is usually at least 4 or 5 times the size of the candle itself. So it stands to reason that a stop loss, the length of that range, plus give or take 10 or 15 pips, is going to net you potentially 100, 150. So the risk-reward ratio for these sorts of trades are very, very good.
Yeah, so we place our stop, usually a couple of pips underneath there. We place our buy order somewhere just above here for confirmation, and that's how we get into this trade. So pretty interesting stuff. Definitely a very good trade so far, and we'll figure out a couple of other reasons why we might want to be in that now. So just for people that are asking if we can follow up on trade from last week, we'll take a look at some things a little bit later on. We'll have a question time. So at the end, if anyone has those questions, ask them now, and we'll go through those at the end. So let's jump back into the slides, and this is another one that people look at. It's a thing called Fibonacci retracements. A few people may have used those before. Some people often misuse them, and I think misdraw them is one of the big things I see. But Fibonacci retracements are really, really important when we're looking for potential pullbacks in the direction of trend and finding reasons to be involved with them. And a lot of people just trade Fibonacci's. Or they might just trade a Fibonacci with a support resistance or a Fibonacci with moving averages or something like that. So we want the Fibonacci traders to be with us if possible.
Because Fibonacci patterns are so popular, as much as we don't want to rely on them wholly and solely, when they're basically backing up what we're seeing in the market in our own trading setup, it's certainly an advantage because we can basically say, well, if people aren't trading the support or resistance that we're looking at or the candle pattern that we're looking at, they could be trading the Fibonacci retracement, which in itself would be a signal to go long or short. The thing with Fibonacci retracements is the golden ratio for starters is actually the 61.8. If you read about Fibonacci anywhere on the internet, you'll find that the golden ratio, the special number, is the 61.8. And a lot of traders actually want that number to be part of their trading strategy. We have a different approach in that we find that the 61.8 pullback is just a little bit too deep. And for a trending market to be going in our direction, we're looking for a 2 steps forward, 1 step back approach, which is really our golden level in our trading is actually somewhere between the 38.2 and the 50. Because if it goes back to a 61.8, we're finding that the trend is actually pulling back just a little bit too aggressively, which means, of course, that the momentum it needs to actually get back up to the initial point of resistance or support, whichever way it was going, is going to be a fair bit more extreme than if it was only pulling back to the 38.2. So for us, if it pulls back more than 50%, yeah, it's almost a weakening trend. So we'll certainly look out for that.
Yeah, I think it's just common sense. I mean, what we're thinking about is if we are in an uptrend and the market pulls back to the 23.6, people are just going to see value there. People are going to say, oh, well, now it's cheaper than it was a couple of days ago or a couple of hours ago. I'm still thinking that it's going to go up. I'll get in. At the 38.2, people are still very confident in that trade. At the 50, people are still pretty confident, but maybe less confident than they were at the previous levels. And that's kind of how I like to approach this 61.8 issue. It's something that a lot of people use. They claim it as obviously the most important one. And it is like kind of the last point before that particular trend is, I guess, from a Fibonacci perspective, I guess, broken. But I like to really trade those 38.2s up to the 50 because I think it's where we have the most confidence from other traders.
It might be a golden ratio for everything else in the world, but I think for trading, the golden ratio for us is probably the 38.2, because we've got to remember that in a trend, pullbacks are actually healthy. What we should be welcoming is actually nice shallow pullbacks in a trend, because that is what makes the trend healthy and strong. If it's pulling back too far, the trend is starting to weaken, and if the trend is not pulling back enough, the trend is going to reverse far more aggressively than we would like. So nice, healthy, gentle pullbacks into the 23.6 and the 38.2 are actually a very, very healthy trend, and we're looking at those for our re-entry points.
So here's just a quick slide, just how to draw Fibonacci's correctly. So obviously we want to draw them in the direction of the upward movement. So we start at the low point, and then we hold and drag to the high point and release at the high for the up movement, and the opposite for the downward movement. So let's just take a look now back at this Euro Yen and see whether we had Fibonacci traders with us in this particular system. So if we jump back in here, we'll notice that, of course, what we want to do is grab the Fibonacci tool, which is up here. We can then left click and hold it down and pull it all the way to the high. And what we'll notice is right smack bang in the middle of our zone here, we've got a 38.2 fib. And I'll just zoom that in so a few people can see it. We've got a 38.2 fib here, right round where our roll reversal point is here and our hammer is.
Let's just change that Fibonacci to a black line so we can actually see it a little bit clearer.
We'll change the color up.
So we'll just change it to black.
There we go, a bit clearer for everybody.
And it also signifies, this actually just is a good example of what we were talking about earlier. The fact that it pulls back to the 38.2 is just a nice healthy pullback right into the point where support is basically being formed where resistance was prior. But had that, if we look at this here, had it come back all the way to the 61.8, which is where a lot of people swear is a golden level, you would have seen that not only would it have broken that resistance area there, which is now support, but it would have actually pulled back to this messy zone. So if it had come back here, the amount of work it has to do to actually get back into the motion that we want it to, it has to break this resistance again, and then it has to break the new resistance up here. So this is why sometimes the pullback is just too aggressive if it goes past the 50.
Excellent. So we've got quite a few reasons to be in this trade. And remember, this isn't, even though it looks like a hindsight trade now, if we literally look at the charts at this point in time, we can be making these decisions. We can say we've got the candle, we've got the bullish hammer, we've got the trend on the moving averages, we've got our support resistance, roll reversal, and we also have our moving average retracement. So quite a few reasons to be in that trade.
So, and just to highlight the point, if we just move the chart right over here and actually just leave the hammer right there, this is what we would be seeing in a live market. So all we would be doing, as you can see, all of our signs that we've actually put on and all the things that we're looking for are all present, even here as the candle's starting to form. So all we're looking for here, like Thomas said earlier, is placing the buy above the hammer candle, maybe 5 or 6 pips above.
Even less sometimes on these
even
times.
less.
Yeah,
and then what happens afterwards, obviously, we know in hindsight, but I guess the point is all of the signs that we were looking for to actually isolate that trade are present in the real time.
And you can do this on any time frames. Obviously, we recommend 1 hour, 4 hour daily. You could use 15-minute, but 1 hour, 4 hour daily is going to be where you're finding more quality, I guess you could say, patterns. So let's jump back into the slides just for a second here and talk about building a strategy using this approach. So one of the easiest and actually hardest things to do is to keep your trading consistent and to keep your, I guess you could say, strategies consistent. So if we build a strategy using these techniques, the simple moving average cross, the support/resistance and roll reversal, candle confirmation, Fibonacci retracements and chart patterns, you'll notice that we can basically start to build a points-based system which we can follow. And a lot of people that I guess, you know, we train and talk to, and even for ourselves, when we first started really heavily trading, we put our trading systems on a piece of paper, laminated them, put them on our desk, and basically said, here are our points. We are only going to place these trades when we have our points all aligning. And it may seem simple, but it's actually incredibly important.
It's very, very important, because what a lot of people do is basically place a trade without really looking at all of the evidence that's supporting where you want to go. And when you're building a strategy, sometimes what you'll find is what looked really good initially is actually not so good when you're trying to actually build a score. So sometimes you'll find that it's nowhere near as good as it looks once you actually try to look for the evidence to actually support the case that you're trying to make for a long or a short. And as you can see here, we've placed the most amount of points on support and resistance, and that really highlights how important it actually is, because support and resistance, even in isolation, is a trading strategy in itself, and a lot of people are very, very successful just using support and resistance with no other basically confirmation. So as you can see, even in this little mini system that we built, if you don't have support and resistance, you have to have 4 different things going in your favor just to make the 100 points. But if you've got a reasonable level of support or resistance to place your trade on, then all you need is a couple of other little things just to confirm that it's actually going to go.
So when we're building a strategy, using these steps, it doesn't matter what your strategy necessarily is, but if you have a strategy you believe is successful, if you just write that down, figure out what you think the most important part of that strategy is. So it may be support resistance, it may be something else, maybe a moving average or an indicator or whatever. You give that the most amount of points, so you always have to have that, and then you build in other confirmations around that to have as many reasons to get in the trade as possible. And it can be really frustrating because sometimes you'll see a trade and you'll go, oh, I got 75 of 100, I can take it. But when you have these points, you know that to get your results consistent and therefore become a successful trader, we need to follow systems that we can replicate to bigger amounts. So if we're trading $1,000 or $100 or $10,000, doesn't really matter right now, but when we move up and we hopefully are successful and we get into 100,000 or 200,000 or million or whatever, we can replicate those results. And a lot of people don't think about scaling their trading.
Yeah, well, look, the most important part about rules and using the right risk management from the onset is so you can actually build your account. Because if you start out, say, with a $1,000 account, and even if you're following the right rules, and you might say, well, I'm going to risk $10 on that $1,000 account to risk the 1%, that's all good and well, and most people will say, we will let that trade run, and we're not going to cut it short. But we need to place the exact same rules if we're trading a $100,000 account with a $1,000 stop loss, which is still only 1%, but the trading rules just do not change. Everything has to stay exactly the same, because that is the only way that you will be able to build your balance up and trade confidently when you start trading with really serious money.
And just like confirmation is key, confidence is key. So
yeah, it's everything.
Yeah, it's actually great to be confident, because when you're confident in your trading, you don't stay up at night, you don't worry about things, you set your trades, you walk away from the charts, and you come back, hopefully in hours or days or weeks time, and whatever time frame your trades are on, and you'll have more success with more confidence. And I think that goes in anything with life. If you become an expert at something and you become incredibly confident in that field, usually you get success, and other people see that success, and it builds itself. It's like a self-fulfilling prophecy as well.
Absolutely. And I'm sure many of you have heard that part of the biggest problem of trading failures is people who let their losses run and cut their profits short. And that's the exact reason why you need these rules-based systems, because then you will never be cutting out any of your winning trades. Because to give you a very quick example, if we have a 5-to-1 trade where we're risking $10 to make 50, most people are just going to leave it in and let the trade play out just as they would and just as they should. But if they were trading $1 million account and we had a $10,000 stop loss and a $50,000 take profit, if you didn't have a rules-based system and you weren't confident that your trades are going to be as successful as they should be, a lot of people are going to see $10,000, $20,000 profit and just exit that trade because they see that as a lot of money. But in reality, by doing that, you're debilitating your ability to make money in the long run, because your system may depend on 5-to-1 trades to actually be sustainable. So if you can't follow those rules and let it run to the full $50,000 profit, because that's what you would do if it was a $1,000 account, then you're letting yourself and your system down.
Yeah, you definitely are. following systems is everything. And I think only when we did that were we actually able to become successful traders.
Absolutely. Now, this is when we look at this too, this strategy is obviously, we've incorporated moving averages in this one, so we're looking at only a trend-based strategy here. If we were looking at a sideways market strategy, all we would do is replace the simple moving average with potentially a stochastic indicator or an RSI indicator, any oscillator that basically has an overbought and oversold level. So you can use that and replace the 25 points with an oscillator that suits that type of trading environment.
Let's just take a quick look at what Tyrone's saying there. So if you're in a kind of like a market like here, where the euro yen was in a range bound period where basically price was reaching a new high, then price was coming down to this low, and you know, we could have analyzed that and definitely seen it here using the channel technique, which we talked about last week, where basically we've got one touch to each side. And when we see one touch each side, two touches each side, we can say the market is range bound at this point. Moving average crosses, they continuously cross every couple of days here, and it's got no clear direction for us to use that. What we want to be doing is we want to be waiting until we see a clear direction, we see a reversal of that, and then of course we want to be involved. And as Tyrone is about to say, he said up the top here, look at these two engulfing candles.
We're going to show you those in the slide, and we'll go back to the slide and actually just give you a quick explanation on those and how they work. But what we can see here is probably the biggest point is that the moving averages are completely useless to us in a market that's going sideways. And that is just standard across the board. Any market that is going sideways, the moving averages are going to give you absolutely no information whatsoever. So it's very important to determine if we're in a trending market, up or down, or in a range-bound market.
And a lot of the ways we can do that is obviously we can use that 200 moving average on the daily, but we can also just look at the charts and say, okay, from the support resistance basics that we know, is it range bound? Here we know that the market broke to a new low, it found resistance here, it broke back through, and at least from this side bit over here on the right hand side, we know that the market at this point is most likely out of the range. And that's because this channel pattern over here was broken previously. It's now negated, we're back into a new trend.
Okay, so what we'll do, we'll quickly go back and have a look at the engulfing candles that we were looking at on this chart. And we had an example here, just here. So part of the candle patterns that we do follow here, we've got a bullish engulfing candle and a bearish engulfing candle. So when we'll go to the live chart, we'll have a look at the bearish engulfing candle example and see how they do actually reverse what would otherwise be a sideways market. So
yeah, so we just got bearish and obviously bullish engulfing here. What we'll see here is we have a strong bearish engulfing candle here. And what that really basically is saying is we've got the bullish candle moving into this point or this high, and then we've got a full reversal in the next candle, and the candle is larger, or it's kind of like eating the previous candle.
Yeah, so basically a bearish engulfing pattern, the bearish candle, which is the red one following the mini uptrend, or not really mini, it's uptrend in that channel, but the body completely engulfs the previous body. So as we can see in these two examples here, the red body is bigger than the green body that preceded it, okay? And if we look at key points in the market, you'll find this actually happens a lot. When you look for engulfing patterns, they can be very, very powerful when they've got support and resistance on their side. You'll see a bullish engulfing candle here, where the green body is bigger than the red body. And you'll also see another one here, where the green body is bigger than the red body that preceded it. All of them are following mini trends, and even though these are just as powerful in a trending market, the good thing about candle patterns is you can apply them to both range-bound and trending markets depending on what you're looking for. So they're very, very useful as part of your analysis.
So as Tyrone said, what we want to do, we want to figure out what the market's doing in terms of direction. Once we've figured out its direction, then we can switch in and out moving averages. But for these particular examples that we've got, obviously, we're going to leave the moving averages in because we've figured that using support resistance that these particular trades are in trend. Now, what I'd like to do is just jump into a really great tool that Pepperstone has, which is called the Pepperstone Smart Trading Tools. So you'll see here we've got them installed on our MetaTrader 4 platform. They're excellent little set of tools that we can use to do a few different things, alarm managers, etc. And one of them is called the Mini Terminal. So I'd like to just jump quickly to the pound yen, which I know is a lot of people's favorite, and I'd like to do some analysis based on those rule-based systems that we use today. So if we jump on the daily first, what we can see is that price is currently above the 200 moving average. So if we zoom in a little bit here, price is above that 200 moving average, and it is also sloping up. That's a good sign for us because that could mean that we might be looking at some form of bullish trade. If we go into a 4-hour, what we'll notice here is we're about to see price potentially break past a very, I guess you could say, high resistance zone. So if we just go and we draw our resistance support line here, you'll notice that around this zone, there's been some support over here. It broke through, the role reversal happened over at this point. It came down, tested this resistance twice, and now we're looking at a break period here, where it's actually broken almost now and closed above. And then what we'd be looking at is maybe a reversal later on, and then a pickup in this zone, very similar to the euro yen. So if we look at the euro yen, we've got that. We'll draw up our line again here. Get rid of that Fibonacci. We've got basically a point in the market where price has broken to a new high. It's then come back down, and it's formed that bullish hammer. So here in the pound yen, if that happened again and we saw basically price move up here and then pull back down, what we could be looking for is an engulfing candle, bullish engulfing candle. We could look at a Fibonacci retracement as well and see whether there's any Fibonacci retracements there. Check our moving averages, make sure they're still relevant, and potentially get involved in this trade. And let's see how we might place that order using correct risk management using the mini terminal. So we'll just drag and drop that onto the charts, really easy to use. Press OK, and it will bring up this little window. So we'll just wait for that to load. There we go. You can see the currency pair, and you can actually put in your lot size, stop loss, and take profit and everything here. What I like to do though is click this little place an order button, and you can put in here order types or templates. So we can have buy, sells, buy limits, etc. So in this case, we'll actually place the trade together. Now, I'd usually wait for further confirmation, but we'll just place it so we can see how it looks. And you can actually select from, instead of fixed lot size, a percentage of something. So if we go percentage of balance, and then we type in 1, that'll actually trade, it'll trade the correct lot with our stop loss and take profits for the account size that we're using. So it's a really good way of, again, following a rules-based approach, using the same risk per trade rather than just putting a single standard lot on and then changing our stop loss. That's something that we definitely want to do with our trades.
Yeah, a lot of people don't put their stop losses on initially and say they'll put them on later, but again, like we said last week, the only thing we have control over as traders is basically how much we stand to lose. And the only thing we can use to protect that is a stop loss. So what this basically does is force you to put a stop loss in to basically work out the right risk ratio for this trade.
So what we'll do here is we're just going to use a generic stop loss of 50 pips for this example's sake. But we'd usually be looking at, hopefully we'd have some kind of candle, and then we could place it behind that candle confirmation, or we'd have a swing or something we talked about last week, or even we can just place it below the moving averages themselves, because they can act as a form of support as the price is moving up. So we'll use 50 here, and we'll set our take profit. Now generally what we'd want to do is, if we were buying here, we'd want to take profit at the next point of potential resistance because we're moving up. So if we bought here, we'd probably place our take profit somewhere around this zone here. So the 144.19, we'll just go with a fixed price and we'll type in 144.19. So quite simple. You can even place stop losses, put order comments, everything like that. So let's place that order now. And you'll see here that it's got the correct lot size, so 0.22. It's placed our stop with a 50 pip stop, which works out to be $98.41, which, because this account was $9,993, pretty good, pretty much spot on. And we can see that our take profit's been put in as well. So if this trade was successful, we'd obviously make a profit of $320, which would be a great risk reward.
Basically a 3-to-1 trade. So yeah. For anybody who hasn't got the smart tools on their platform, just talk to your account manager at Pepperstone and they'll be glad to help. They're not standard with the MT4 load-in. So
no, this is definitely a Pepperstone only thing.
So you will have to just talk to your account managers there at Pepperstone and they'll sort you out.
So a couple other things we wanted to do, and we will go into question time in just a minute. I just want to talk about some of the things we're seeing play out in the market at the moment. So we'll jump over to the Australian dollar. I just wanted to mention that this is still within the channel that we discussed last week. So we'll notice that price is still stuck within this zone, but it's moving to the upside of the channel. So this could give us a potential entry off the channel trading discussion we had last week, maybe even in the next couple of weeks, maybe even this week, if it gets back up here and we see some reasons or some rules-based reasons for us to get into that trade. So again, things like candle confirmations, you know, change of trends, those kind of things to the short side.
So like we said earlier, we need to be mindful that in an environment where we're trading inside a channel, a moving average is not a good idea to basically place your trades on. So what we're looking for here is getting up to the resistance zone, looking for a potential candle pattern reversal, maybe a Fibonacci retracement, you know, or an oscillator to tell us that it's overbought or oversold.
So something like that is obviously what we're looking at. We'd sell this side, and if it broke through, as per last week's channel trading techniques, we'd be looking for actually this kind of movement to the upside, so the break side. And this will happen on any time frame. It doesn't have to just be weekly, but we do notice that this Australian channel is still in play currently. The other thing that we wanted to do was talk about the US dollar CAD. So the US dollar CAD has a couple of the rules-based systems that we talked about tonight. So let's just jump back into those slides. Basically, we had that strategy, simple moving average cross, support resistance, candle confirmation, Fibonacci retracement, and chart patterns. And we needed 100 points. So if we go back to this particular chart and we go to a daily time frame, what we'll notice is that price is now below the 200 moving average on the daily, and the 200 moving average on the daily is starting to turn down. So that's probably signifying bearish movement.
Definitely a weakness in the overall longer term trend.
We go into the 4-hour chart, and what we'll notice is that the 20 has crossed, or is just about to cross, below the 50. So that's really important. Then what we'll notice, if we draw up our recent support resistance, we had some support over here that's now broken through and become a resistance point. And there's a particular pattern here as well, which is called a flag pattern. So if we actually, we're not going to cover this too much this week, but we will, you know, in the next coming weeks. If we actually look at this pattern is signifying a strong break followed by consolidation, and then hopefully we see another break and we can get involved with this kind of trade. We can also place Fibonacci's on here, and we'll notice that the Fibonacci retracement did not go back above the 50, and we see this 38.2 revolving around that support resistance level, which is really important.
So that role reversal is going to become very important as it's backing up this flag. So I think what we've done is basically given it about 125 points, I think.
So yeah, we pretty much maxed this trade, but these are the kind of things that you're going to want to be looking at in the market, and these are the setups that you can build. And as you add more technical, I guess, things to your repertoire, so more things like you know, could be more chart patterns, different types of chart patterns, even some indicators. You can add that into your rules-based strategy, and then once you have enough reasons, again, you might down some of the points, mix around with it a little bit, but every time get that 100.
Absolutely. And look, is it going to guarantee you success following the strategy like this? Well, of course not. But what it will do is give you a far better chance than just eyeballing the chart and basically picking a direction. You're doing something that a lot of other people are seeing, potentially 5 different trading strategies in one. And of course, if the trade doesn't work out, we know that we've got the right risk management in place, and we just pick up our bat and ball and get ready for the next one.
Good terminology. All right, well, that pretty much concludes this section of it, but I believe we have question time, so I'll take it over to Sam now.
Yeah, absolutely. There are quite a few questions, actually. I pick up just a few to start with and see how we go. Brian was basically asking if he prefers to trade intraday, so 15-minute charts. How would you apply those moving averages on a shorter time frames?
Yeah, so what you'll want to do is the same moving averages can definitely be used on the 15-minute time frame. So if we went to a 15-minute chart here, we could definitely work with those kind of moving averages. One thing I would, one thing I'd want to be doing is probably focusing on maybe the hour 200, so maybe 2 time frames above, as giving us kind of the trend So the 200 on the hour will give us the overall trend, and then the 20-50 cross on the 15-minute should be excellent, I think, for that. But yes, definitely can use moving averages on the 15.
Yeah, excellent, perfect. Now there was a question in relation to hammer, and George was saying that he kind of see hammer along the line, the trend. So as a trend is developing, he might see a hammer, and how we differentiate between a hammer on the support and resistance or a hammer within a trend. So which hammer to take?
Ty, you want to answer that one?
Okay, so with a hammer, again, like we said, it's basically a reversal pattern, yes, but we can use it at both. If the hammer is actually at a place of support, especially if the hammer portion of it is below the support line and the buyers push it up above the support on close, that actually makes the hammer probably 5 times stronger than a normal hammer. So if we've got support on the hammer's side, definitely that just makes it a very, very strong pattern. In terms of how it goes on a trend, what you'll often find is a hammer inside a trend happens on a counter trend pullback, and quite often you'll see that the hammer will basically hit a moving average. So if we're tracking up and following the 20 and the 50, quite often part of the hammer will hit the 20 or the 50 moving average below it, and that actually acts as basically dynamic support. So as much as support is usually a straight line, a moving average provides dynamic support in the trending market. So if the hammer is touching either of those two, it is definitely stronger. In isolation, without support, it's still definitely there, but not quite as strong if it hasn't got the backup of a solid support level or a moving average to help it.
Yeah, we always want to look for other reasons, every single time other reasons. So even if we didn't have support resistance, if we had those other reasons, very strong still. Just not that great by itself, really good with other things.
Yeah, excellent, perfect. There was another question coming through from Josh, and he was asking if it's possible to trade uptrend within a channel. So you have a channel on a higher time frame, let's say daily, and you see uptrend on, let's say, a 1-hour chart. Is it still possible to trade that uptrend within a channel?
Yeah, you definitely can, but you just need to be aware for your take profits. So the reason why we really want to look at, let's say this Australian dollar is a really good example right now. We've basically got price trapped between these 2 different points. So if we were trading uptrend here for any reason, let's say just right here where price is now, we wouldn't want to be saying, oh, I think profit is going to be up here. We're not going to have over like a crazy expectation for where price is going to go, and that's the beauty of these technical or this technical analysis. We always have an idea of where price should go, and therefore we're not going to basically get stuck in a point where we say, oh, we think that this trade's going to go for 200 pips, and then it only goes 100 pips, and we get broken even or lose that trade. We're going to say this is where it should go, and change our take profit accordingly.
Yeah, in a lot of ways, Josh, what you'll find is that when you've got a big channel, like say on a daily or a weekly, and you are trading the smaller trends inside that, you actually, because you've got your very defined take profits, it's actually very easy to work out your risk-reward ratio. The problem with a lot of trend trading and actually going in the direction of trend is we have no real clear direction of when that trend is going to end. So what a channel gives us is, especially a larger time frame channel, it gives us very clear direction of where the shorter term trends, or at least at the very least, they're going to weaken. So we've got very clear take profit zones. So yeah, absolutely. If you see them in the bigger channels, trends are awesome.
Yeah, I just put this odd example up. I think this is a good point where if we actually, let's just jump into that template here and go down to the 4-hour. What we'll see here is we've got the, it's just going to make it a little bit, there we go. We've got the 20 above the 50 at this point, and you'll notice here that we had a break above this previous resistance and then a pullback. So I drew up that Fibonacci there just to show you that the pullback came into the 23.6 pretty much perfectly. We didn't necessarily get a candle confirmation here, but it did come back almost perfectly to our point, just a little bit too quick, and then it went off into into the I guess the
basically
higher
continuing
points.
on in the trend direction. So yeah, that's a really good example of the bigger channel, which is the daily. It's basically a 4-cent range. So basically between 77 and 73, 72.
Yeah.
So you got 500 pips of movement there. So channels definitely play a role in helping the trend reach its I guess designated place, which will be about 77.
Yes. Yeah. So good question.
Excellent. There was another one in relation to moving averages. If there is any reason why you guys are using SMA over EMA?
Yep. The main reason we use the SMA is because, especially in the smaller time frames, what the way an EMA moving average works is basically an exponential moving average. So it's actually got more weight. The simple moving average is weighted equally right across. So if we're doing a 10 SMA, every bar of those 10 bars is weighted equally. Whereas the EMA, the exponential moving average, more weight is placed on the first few bars, and it actually gets less and less as it happens. Now, what you'll find, if you place a 10 EMA and a 10 SMA on the chart, you'll find that the 10 EMA often, it will definitely be faster, so it'll be actually a little bit more reactive. But the problem with that is it actually gives you more false signals. So what you'll find is that it'll move in a direction, and you may anticipate the move a little bit faster, where the simple moving average actually gives you just a more smoothed look at what's actually happening. Is there a wrong or a right? Absolutely not, but you just have to be aware that the EMA is a little bit faster, and as much as it can get you in the trade a little bit earlier, it can often give you a couple of false breakouts that a simple moving average just won't give you. So it's personal preference, as long as you're aware of what each of the EMA and the SMA is representing.
Another good question.
Excellent. Charles was asking if the trading on a 4-hour or daily chart, if he's trading on those time frames, how would you incorporate economic events coming up as upcoming economic announcements into your strategy? If you would take profit ahead of those announcements, or just keep the trade going?
Yeah, it's a good question. Last week we actually had up a few of the things we do look out for. My personal opinion, or my opinion over the last couple of years, has been that often, if you're trading in the direction of trend on the daily anyway, that economic news actually helps you a lot more than you think, and actually boosts you to the profit, because you're trading in the direction of trend, and often that trend started because of some fundamental event, and then the continuation of those fundamentals pushes it in that direction.
Yeah, quite often on the 4-hour and the daily charts, you've usually got, if your trade plan is done correctly, you've usually got a stop loss that's sufficient to actually handle a lot of the moves that the economic news will sort of throw at you. It's actually basically noise. A lot of it can be noise. So look, I guess to answer that question, if you were trading a 15-minute or a 1-hour chart, news definitely plays a part in potentially taking profits a bit earlier, because your stop loss may be hit artificially just by noise. But when you're trading the daily and the 4-hour, quite often you'll find that it will probably more than likely help you more than hurt you, because the noise won't take out your stop prematurely.
I'd also like to just add on that one last thing. Non-farm payrolls, probably the one bit of news, kind of like things like Brexit as well. If you ever see those really massive news events, Brexit, non-farm payrolls once a month,
election, like the
US election, yeah, definitely, or elections specifically to that pair, you may want to consider taking out your profit or loss even at that point. Non-farm payrolls is a particular sticky one, I guess, because it's very difficult for the market to properly, I guess, look at a result and figure out what the fair price of the currency is after that. So you'll notice that non-farm payrolls tends to be the one where price goes up and down and all around, and then at the end of that it ends up at the same point.
People just like messing about in non-farm payrolls.
Non-farm payrolls are scary.
And it can be fun. Look, it can be fun, but just be very mindful that a reasonable non-farm payroll result either way could send the market spiraling 2 or 3 cents in either direction, and we've seen it. And still end up exactly where it started 5 minutes later. So any stop loss that could survive that has done pretty well.
Yeah, so non-farm's definitely one I steer clear of personally. I also think that, with those big Brexit-style elections and stuff like that, you're going to want to be a bit careful.
Look, when you do proper analysis and you really look out for what you're doing, there's so many opportunities in the market and so many good trading opportunities all the time in so many different time frames. you're never going to be short of placing some good trades. So realistically, if you can avoid it, it's probably always better because you're going to basically preserve your capital.
Excellent. Anything else there, Sam?
Excellent. Maybe just one quick one, and then one a bit more technical. If there is any rule of thumb for drawing Fibonacci retracements, where to put a high and where to put a high, where to put a top and a bottom of the Fibonacci retracements.
Yeah, Tyrone.
Sure. So with the Fibonacci retracements, again, it's one of those things that can be a little bit subjective. So I mean, obviously everybody's drawing a Fibonacci to what they think the swing will be. So I guess what you're probably looking for, like in this instance here, where we've drawn the Fibonacci from this low here to this high here, at this point in time, that's the only information we've got. So if we take this chart, we'll just click over here and we'll move this chart over here. At this point in time, before we know what's going to happen in the market, that's the only information we've got. So the high and the low of that Fibonacci basically drawing is very, very easy. But as you can see, it's not just a hindsight thing, because we can see very clearly that that information alone has given us the 38.2 or the 23.6 zone where we can actually trade off. What happens later makes it a little bit more interesting, because we can say then, well, should we be drawing this low to this high, or should we be doing a second one basically and just recapping and seeing if they overlay. What we generally do is, if it's too subjective, we don't use it. Or I've got to be very clear in that we don't use Fibonacci wholly and solely as the reason to trade. If it's there and it's backing up what we're seeing, yes, we can tick it off and say, okay, we'll take some points. But we certainly would never trade just using a Fibonacci retracement. So it really comes down to what you're looking at. But of all of the rules that we've got there, the Fibonacci is probably the one that I would say, in isolation, it's the one that you've got to be very, very careful of. So only because it's the one that's the most subjective. Because again, everybody's drawing their Fibonacci's on what they think is the swing. And what I see as a swing here, Thomas may see as a swing of that whole distance. And although that could give us similar results, it may not be at the time of the market when we want to trade.
Yeah, what I'll also do is, if you're asking about whether it goes to wicks or anything like that, I usually just draw the entire move and kind of just approach it from, like, if we saw this big move here, let's say all the way down to this point, and we were drawing a Fibonacci, I would be fine at this point to start drawing the Fibonacci, and I'd also be fine to draw it all the way down to here at this point. And the reason why is it's all one clear move, and if we move to a line chart, pretty clear. Yep. But that's just like a rule of thumb, kind of like the way that you're going to look at it. And sometimes you'll even draw both, and you'll find that a Fibonacci will actually come over both points.
Yeah, and a handy tip actually, in a situation just like Thomas showed there, if you do have to draw a second Fibonacci over the first one, it's actually a good idea to change the color, so you can actually see which Fibonacci is giving the support or resistance. And what you'll often find is, if it does do one more swing down, you'll find that the 23.6 and the 38.2 will actually overlap. And if you change the colors on it, you'll see that. And that gives it, what you're basically doing is getting two sets of Fibonacci retracement traders basically getting the same support or resistance. But to measure it, definitely go from wick to wick.
Yeah, wick to wick's best.
Excellent. And we have maybe even a last question from Mark, which I think will be particularly useful for anyone who is starting with MT4. So once you draw all your EMAs and SMAs on your chart and change the colors of candles and maybe even have that mini terminal applied on your chart, is there a way how you can set it up as a default chart? So every single chart that you want to analyze, you'll have the same settings?
Excellent, really easy one. What you can actually do is, let's say we've done this particular chart and we're happy with the way it looks. We'll get rid of these indicators. We can basically right click on the chart, go down to template, and then left click on save template. We can actually save this template as whatever we feel like calling it. So in this case, I called it Learn It Live Template 2. And then every time we open up a new chart, so let's just do that together now, and we'll just open up the odd US dollar, we can right click on the chart, go down to template, Learn It Live Template 2, there it is. So really easy way of doing that. And we can even save profiles in MetaTrader 4 and do a few other things that keep it all nice for us moving forward as well.
It's very important. It's a very good question, because what you want to do as a trader is become very familiar with the moving averages that you're using and their colors, so you don't have to actually, so at a glance, you know exactly what is what. So it makes your analysis far quicker and a lot more consistent.
So I'd just like to say thank you to everyone that attended tonight. Obviously, we hope to do a lot more of these in the future, and we hope you enjoyed.
Great. Thank you very much, guys, and thank you for your questions.
Happy trading.